Good afternoon and welcome back to the Camarda Wealth Channel. I am your host, Troy Lerche, bringing you this week in wealth. I want to take a minute to thank Kim Camarda for filling in for me last week and doing an amazing job talking a little bit about the market's technicals and Evergrande. That'll be a little theme in my report today. But first, we'll start with our CAPE indicator is at 38.48, and we have 3 of our 4 indicators are now positive. Last week, the S&P was very volatile to start the week. I think we were down 600, 800 points at different points on Monday. After trading without a 5% pullback since October of 2020, the S&P broke its upward trend and sliced through its 50-day moving average. Traders and investors searching for a reason they could sell they could point to any number of scares: Fed tapering, supply chain disruptions, the Delta variant, stock market technicals, and Chinese property developer Evergrande's financial pressures was a big one. While each of these scares were already known, the deck was stacked against equities and left them vulnerable to a sudden sentiment shift. With Evergrande, the financial pressures were go-to selling excuse as the residential property developer ran into cash flow problems, unsurprisingly resulting from its expansion into non-real estate businesses, including electric vehicles, sports, amusement parks, and food and beverage. A few headlines called it China's Lehman moment. As a lot of you know, Lehman Brothers meltdown happened in the financial crisis of the 08. But we attributed the company's problems to overly ambitious management team. The primary question becomes how the company's $300 billion worth of liabilities is satisfied and if the losses create systemic risk. Regardless of the outcome, we expect the Evergrande's leverage issues to have a negligible impact, if any, on U.S. corporate fundamentals. We remain constructive on the market. The earnings growth, accommodative central bank policy, and themes are all still intact. Central bank policies and fiscal stimulus themes are all still intact. While we do not expect a market correction, there are headwinds overhanging the market. 5% pullback hardly qualifies as oversold, but we do expect a lot of volatility going forward. We are currently not rushing to de-risk, but we're also not rushing to add any additional risk in the market right now. The second big event was the Fed September FOMC meeting. The Fed held interest rates steady and indicated it expects to start reducing its monthly bond purchasing, quote unquote, soon. There are a few items worth calling out. First, the more Fed members anticipate the first hike occurring in 2022. The dot plot is evenly split between 9 members anticipating a 2022 rate hike and 9 members expecting to hold steady through 2022. Second, the Fed updated its economic projections. The Fed cut its 2021 GDP growth forecast negative 1.1%, but increased its 2022 growth forecast by 0.5% and 2023 forecast by 0.1%. Separately, the Fed raised its 2021 core PCE inflation estimate from 3.4% in June to 4.2% today. Figures, credit markets interpret more hawkish, with the 2-year, 3-year, and 5-year yields all rising 0.03%. The September meeting was a positive catalyst for multiple reasons. While the Fed's expecting tightening sets the economy on a slower growth path, the trajectory is more sustainable. The Fed's own updated GDP projections appeared to acknowledge this, and we agree. At the same time, the Fed is going to great lengths to avoid being the reason the recovery stalls. Investors are giving the Fed plenty of room to act as it sees fit. And the equity and credit markets are incredibly well behaved compared to the 2013 taper tantrum. That's a win for the Fed Chair Powell, as give emphasis on clarity communicating the Fed's policy in the marketplace. And finally, most people haven't even begun to think about doing their Christmas shopping. After all, it isn't even Halloween. But maybe you should. Retailers attempting to stock up for the holiday selling season are facing all kinds of shortages, transportation chaos, and surging prices. As analysts point out, the inventory to sales ratio started collapsing last year, and in May it hit an all-time low in the data going back all the way to 1992 and has only regained a small amount since. Memories of an 80s era fistfights over the Cabbage Patch Kid dolls come to mind. Well, that's all for today. Again, if you like the content, please hit the like button and subscribe. Next week, be on the lookout for a video that I'm going to change it up a little bit. I'm going to do next week's video about health savings accounts, or HSAs, and how powerful they can be. So make sure you don't miss it, and have a great week, and we'll talk to you soon.